I am going to talk about in this session psychology and emotions and the role that they play in an investor's career and decision making. There is a saying that emotions is the enemy of a great investor, and that is very, very, very true. We are, as human beings, the only life form that has been gifted with a mind. And with our mind, we have what we call our intellectual faculties and emotions. We use our intellectual faculties, and the way we use those faculties determines the emotions that we feel or we express. I'm not going to go into the details of how it works, but just think about this. Every one of us has an imagination. We have memory. We have reason or reason. We have perception, and we have intuition. Now, all of those are faculties of the mind, intellectual faculties of the mind. The way you use your imagination determines your emotional state. The way you use your memory determines your emotional state. Now, the point of all of that is to suggest that you cannot separate emotions from the investment game. However, emotions and psychology can be your greatest enemy. Richard Feynman, a physicist, once said that physics would be much harder if electrons had feelings. You walk into a room, you switch on the light comes on. As you walk out the room, you switch off the lights go off. The electrons that make that possible do not have the ability to rebel. They don't say, I don't feel too good today, I'm not going to come on, or I feel a bit low. They don't get to choose. Science and physics works by laws. Switch on the light, it comes on. Human beings, on the other hand, we're quite different. The investor has to understand, I should really say you have to understand the role that your emotions will play in your investment career and in your investment decisions. If I asked you, and if I had 100 people listening to me in the same location, and I asked the question, how many of you consider yourselves as long-term investors? Most people would say yes. Most people will raise their hands. Everyone is a long-term investor until something goes wrong. The market starts to go down. There is a correction in the market. There is what's called a bear market, which is a euphemism for when you lose a lot of money. And suddenly the same people who call themselves long-term investors act in a very short-term focused way. Why? Emotions. Because we're human beings. We are human beings. And therefore, understanding how to take advantage of the psychology of the market or the emotions in the market is extremely critical. You have to be rational. Investing is not an emotional game, it's an intellectual game. You must be able to discipline your disappointments and subject your emotions to check. Well, that simply means that you do not react, you do not make long-term decisions that would affect you long-term based on short-term outcomes. I'll give you a simple example of how that could happen. You buy a stock in a company, and for whatever reason, the market goes down 20%. What do? Now, most people before they've experienced a correction or a market downturn, would boast that they would behave more maturely. Unfortunately, in the heat of the moment, what most people do is they panic and they sell. The same stock, if that same stock had gone from 20 to 30 to 40 to 50, they buy. In other words, they go against the real fundamental advice when it comes to investing, which is buy low, sell high. So as the price goes up, people become euphoric and they want to buy more. As the price comes down, people become fearful and they want to sell at any cost. Now here is the problem with that. If you've done your valuation and you've estimated that the intrinsic value of that asset is £40, and if the market price goes from 20 to 15, what is the logical thing to do? Well, I like to think that the right thing to do would be to buy more. In other words, your pound cost average, the further it goes down, the more you buy. Why? Because you've identified that the value exceeds the price. Really simple. If on the other hand you estimate that the intrinsic value is £40 and the price goes from £40 and goes all the way up to £65, now price exceeds value. What should you do? I hope you would not say buy more, because that is the wrong answer. If you've identified that the value is £40 and the price, as a result of optimism in the market, the price has gone up to £65, the right thing you should be doing is re-evaluating your portfolio. You should be selling. Now, you might decide not to sell, but if you make that decision, it should be based on logical reasoning. For example, you've estimated that the value in a very short time will grow up to 65 and will continue to grow. So you might be one of those people who follows the approach of buy and hold. In other words, you buy a good asset and you simply hold on to the asset. I talked about two fundamental responsibilities of an investor. The first I said was asset selection. The second, cycle positioning. In other words, once you've selected your assets, you then position your portfolio in accordance with the psychology or the emotions of the market. Now let's come back to today's theme, which is the role that emotion plays in your decision-making process. How do you combat and how do you contain irrational behavior on your part? Remember, the view you have of the market is intrinsic to your fundamental investment philosophy. If you see the market as something that should guide you, then your decisions will be different. If you see the market as something that should inform you, your decisions will be different. My view is this: the market should never guide you. The market should inform you. The market simply provides you with information. You should do the analysis. So when everyone around you or everyone in the market is losing their head, you should stop and say, could they be wrong? There is some theory, I'm not sure how true this is, about Norwegian lemmings. They are like rats, rat-like looking rodents. They run off a cliff, or they are seen to run off a cliff and fall into water. National Geographic had some videos about this. Now, I'm not sure how serious or how true the statement or the idea is. But the whole point is this. The question people asked was, you had this herd of lemmings, a huge group of lemmings. Why did they all run off the cliff and commit suicide? What were they doing? Now, I want you to think about this question. There was someone in front, there was one lemming in front, leading the pack. And let's assume they were all unaware that there was the edge, and they were all unaware that they could fall off the cliff. The first lemming falls off the cliff, the second, the third, the fourth, 500 have fallen off the cliff, but there was a lemming at the end. And suddenly it has seen, that's the right reference, it sees the entire pack disappear. Now, why didn't the lemming stop and say, oh, hold on, something doesn't seem right? Why did the last lemming go off the cliff with the rest of the pack? Now think about that question. Now I could replace lemmings with human beings. There is a saying, most people would rather die than think. Many have. We seem to love group decision making. We like to delegate the decision making to others. So we work in the same herd-like fashion. One person says run, and everyone runs. Now I want you to try this experiment. I've done this so many times with friends. You walk to a traffic light, and let's assume that the traffic light, the pedestrian part of the traffic light is on wait, simply meaning that the cars are allowed to go past. You, the pedestrian, has to wait. I'd like you to try something, or maybe just observe the behavior of people. I'd like you to observe if there are a number of people waiting for the pedestrianized side of the traffic light to go green. I want you to watch how many people look towards the road, assuming that the cars are coming from your right and you're crossing the traffic lights. We call it pelican crossing. I'd like you to look and observe how many people look towards the direction of the road before they cross. Remember this, a traffic light, cars going past, a pelican crossing, people, pedestrians going across. The way it works is the cars are allowed to pass, the lights go red, the cars have to stop, the pedestrianized lights go green, saying people can pass. I want you to observe how many people look towards the road to see that the cars have actually stopped before they cross. My observation, 90% of the time, is that there is a section of people who simply follow the directions of others. They don't look. As soon as one person starts to walk, they walk. It's almost subconscious. And that simply means that we are very good at following other people. It's a herd-like mentality. There are only very few people who stop and look. Now, I have seen, very, very sadly, almost a catastrophic accident on one occasion where everyone is waiting. One person is impatient, but he looks and he decides to cross, but he's looked. So he understands and he's calculated the risk. He knows, I have to walk as fast as possible to get to the other side. As he starts to walk, obviously walking very fast, almost jogging across, a few people behind start to walk, but they do not look. Unfortunately, but also, luckily, the car doesn't hit them back down, but it gets very close. The point I'm making is this. Herd-like mentality in the marketplace is no different from herd-like mentality in how we live our lives. So, as an investor, one of the things you should do is think for yourself. Remember this, you are neither right because the market agrees with you, and you're neither wrong because the market disagrees with you. You're right because your facts and your reasoning are right. And that simply means, as an investor, this is an independent process that you must go through. If you want to be actively involved with choosing your investments, you have to be a good thinker. In other words, you must even be a contrarian thinker. But understand that contrarian thinking does not mean that you always disagree with everyone. There are moments, and those moments do not come very often. But at the height of the cycle, at the extremes of the cycle, like a pendulum swinging to either side, it swings to the extreme and it swings to the other extreme. At the extremes of the cycle, it's important to have a conservative, a contrarian approach. Why? Because at those extremes, the crowd, the market, is likely to be wrong. In other words, when everyone is fearful, be greedy. When other people are greedy, be fearful. Do not always follow the path of others. But remember that being different or being a contrarian doesn't necessarily mean being wise or being intelligent. I'm saying emotionally, it's important to always question the decision of the group. There's a saying by Warren Buffett where he says, it's only when the tide goes out that you realize or you find out who has been swimming naked. You know, when the tide comes in and the water level rises, no one can really see you're naked. When the tide goes out, they will realize some people are not wearing swimming trunks. Think about this. You have a river and you have a duck swimming on the river, and it's raining. And as it rains heavily and heavily, the duck starts to float and go even higher and higher. And the duck starts to think, I must be wise, I must be intelligent, without realizing that the rain is increasing the water level, and therefore the float is able to float even better, not because he or she, or it, I should use the word it, not because it is very good at swimming, but because the rain has increased the level of water. Emotions. If there is anything that will affect you in investing, in many cases it will not be because of the action you took based on your reasoning. It will be because of the action you took based on your emotion. Remember this. If you can control, regulate, understand your emotions, you increase the probability that your decisions will be more favorable by an incredible margin. If you've studied most of the great investors, one of the things they say is that you do not need a high IQ to do well. You do not need to be very intelligent. Yes, you need to understand numbers, but you do not need a very high IQ. Warren Buffett says, if you have an IQ of 150, he says, give away 30, because you do not need that much. But what you do need is temperament, emotional control, good psychology. You need to be able to control yourself. You need to be able to think independently, and you need to be able to question your decision-making process. Remember what I said, investing is an intellectual game. It's not an emotional game. You cannot apologize. You should not make your decisions emotionally. So here is the point I'll leave you with, or a bit of advice that I'll leave you with. Whenever you're making a decision with regards to investing, it's important to see yourself as a debate in a debate team. See yourself as being in a debate team. I use this analogy in one of the earlier sessions. I said, in a debate team, the way it used to be done traditionally, you had a debate coach. You were given a topic. The coach would come and say, this is what the topic would be for this week or for this month or for this course. And you were asked to prepare. However, you were not told whether you would be arguing for or against the debate or the motion. On the day of the debate, in some cases, a few minutes or even a few seconds before the debate begins, you're asked to move to the side supporting or arguing against the topic. Now, what did that do, and what was the purpose? The purpose was simple: preparation. It was done in that way to enable you not to have any biases, to put aside all priors and biases that could flaw your inference. And that allowed you to prepare objectively, so you could argue for and so you could argue against yourself. Scott Fitzgerald made a statement that I think is profound. He said, the sign of first-rate intelligence is the ability to hold two opposing ideas in the mind at the same time and still retain the ability to function. Let me translate that. Can you argue on both sides objectively, unemotionally, and still retain your ability to function? So let's bring this into your investment process. Before you make an important decision, and my recommendation is to take all decisions as important, get a piece of paper. Let's assume you bought a stock in a company at £20. The price has gone down to 16. The price falls further down to 12. Everyone is panicking and everyone is selling. You want to sell. You put out a piece of paper and you say, I'm selling this stock because, and you list all of the reasons why. And then you also state, I should keep this stock because. Now, if you had followed some of the recommendations I gave in the earlier sessions, I also recommended that you do the same when you were about to buy the stock. Before you make an investment, you should always do the same thing. I'm buying this investment, or I'm investing in this opportunity because, and you list all the reasons. And then you should also say, I should not buy or invest in this opportunity because, and you should list all of the reasons. If you bring both reasons together and you just let it be, give it a day, give it a few hours, preferably my recommendation is at least 24 hours, and you come back. Because you see, sometimes emotions can become so strong that they take over reason. I'll say this again. Sometimes emotions become so strong, they take over your reasoning faculty. Your reasoning faculty is the faculty of the mind that allows you to think. Let me go back on what I explained at the start. I said, you have an intellect. You have intellectual faculties. The way you use your intellectual faculties determines your emotional state. The way you use your intellectual faculties determines your emotional state. And therefore the story you present to yourself. And therefore the strategy that you adopt or you take. Now this is critical. Very simple, but it's critical. You have an intellect. You have intellectual faculties. The way you use your intellectual faculties determines your emotional state. Your emotional state frames a story. The story you frame or you label determines your strategy. So my advice would be, recognize that in your intellectual faculty, you have imagination. With your imagination, you can minimize an experience or you can maximize an experience. With your imagination, you can think positive or you can think negative. With your memory, you can recall the past and what happened. With your intuition, you can regulate and you can say, this is what I think could happen. With perception, you can see the other side, simply perspective. With your reasoning faculty, you can think. Emotions, when you're overwhelmed with emotions, it overrides your reasoning faculty. And that is why it's the greatest enemy of the investor. And if you cannot think, you automatically should take the position that passive investment is the right approach for you, not active investing. Because to be a good active investor, you must be able to think independently. I'll leave you with something that I think it's important to understand. I hope it comes across the right way. If you invest in the stock market, or if you invest in equities or bonds, I'll use stocks for this example, you're always going to have volatility. You have cycles. And those cycles occur because of the involvement of people. And those cycles refer or infer emotional states or the psychology of the participants in the market. So you will have cycles. You might buy an investment and it might go down in value. But you must be willing to act with equanimity to a market decline. I'll say that again. You must be able to act with equanimity to a market decline. Simply means, if the market goes down by 20%, in order for you to consider yourself as an active investor, you must be able to act with equanimity. That simply means you simply go back and say, what is the market telling me that I do not know? What information is it giving me? Remember, the market should not guide you. If you're not willing to act with equanimity to a decline in the market of 20, 30, 40, or 50% over a 10-year period or over a 12-year period, you have automatically made the announcement that you're not fit to be an active investor. Here's the point. If you go back and you study history, if you look at the last 100 years, one of the things you find out very, very clearly is that we always have, over the last 100 years, a market decline of almost 50% every 10 to 12 years. Now, that's not set in stone, but within that time range, between 8 and 12 years, there's always a decline, a correction. The point is, you will always have excesses in the market, meaning high psychology, excitement, and you have corrections, which is low psychology, fear, and anxiety. If you're not willing or able to be agnostic, to simply ignore what the market does by going down, then you disqualify yourself from being an active investor. And the reason is simple. If the market goes down by 50%, you should be excited. Think about this. You go into the supermarket and you want to buy, say, baked beans, Heinz baked beans. It's selling for 33 pence. You buy some. If you walked into the shop the next day and the same baked beans are being sold for 10p, 10 pence, which is roughly 70% discount to what it sold for the previous day, what do you do? The answer should be you buy more. If you like baked beans, you buy more. Why? Because you've estimated that it's selling at a price lower than its value. So lower price should be attractive. Lower prices means you get more return for your investment. Here's the qualification, and then I'll stop. Providing you understand what the value is. And that simply means the process of estimating value is ongoing. You can't estimate the value of Apple in 2007 and just never go back and revisit your valuation. The process of valuation and estimating the intrinsic value of an asset should be something you do regularly, so you can understand when value exceeds price and when, unfortunately due to the emotional excesses, price exceeds value. Having that understanding means that you're able to decide when to adjust your portfolio and when to hold, to stay, or to sell.